Hello, here is the Graham Team's first quarter 2023 housing market report. We are already well into second quarter. We can tell you the market's starting to shift. So we will be updating you throughout this first quarter report of what's currently happening in the housing market so you can stay current. Home appreciation in 2023 has remained flat for 5 straight months at $425,000 for a single family home. That's the median sales price. The single-family homes leveled off starting in December of 2022 at $425,000, which reversed a prior 6-month decline from June to November. The median home size has stayed about 1,900 square feet. The grid that we're showing here shows the most significant changes year over year for every first quarter period for the last 3 years. As expected, first quarter of 2023 has declined from first quarter 2022, both in price and sales activity. What also is significant is the amount of appreciation that still has occurred between 2021 and 2023. Looking closer at the window of comparison of fourth quarter 2022 to first quarter 23, besides the flat median sales price, there are some other interesting trends occurring. The number of sold homes is up 13%, days on market is also up 15%, and inventory was reduced by 51%. Typically, we would expect to see sales prices rise when inventory drops by 50% and days on market to reduce, not go up. What is causing this mix-up in the market? My answer is affordability. When interest rates were below market norms at the 5%, it opened the opportunity for buyers to purchase homes at a greater sales price than the traditional market would support. With interest rates ranging between 5.75 and 7.25% this quarter, it has kept buyers from qualifying for homes, thus decreasing demand. However, there was enough demand to keep the market stable, reducing the days on market. The lower inventory levels are also tied to interest rates as well. Those normal life events that typically trigger a buyer to move up, to enter the market and become new home buyers, stop from doing so because they can't afford the new payments at today's interest rates. Believe it or not, this is also affecting the downsizer seller buyer from entering the market because even at today's reduced median sales prices, their payment would be greater than the larger home they currently own in many cases. So who is selling them? Those who own their homes outright or have substantial equity and are not affected by interest rates for the purchase of their new home, or those are experiencing life events that they have to sell. We're also seeing investors starting to put some of their inventory on the market. Here are the 3 core factors affecting Southern Nevada's housing market. Number 1, affordability. Still, the core reason for decreasing sales volume and the reduction in sales prices year over year, taking no one by surprise, is the home affordability problem. The rise of interest rates from record lows of 3% to a more average rate of 6.25% has moved buyers out of the market. Even with the year-over-year median sales price reduction of 10%, the total monthly house payment at today's conventional mortgage rate is 7.3% on a purchase price of $425,000 is $542 more than the conditions existed in March of 2022, where the conventional mortgage rate was at 4% and the median sales price was at $470,000. This means the average household income would need to make about $19,700 more this year to qualify for the same home as last year. As we shared in our last update, this means the median household income is around $69,000, and to qualify for a conventional home loan at today's interest rate, the household income would need to be about $116,000. This is a significant gap. We'd like to cover a couple of scenarios and how this affects the average home buyer. Let's first start with scenario A. To purchase the same size home as last year at a 10% lower purchase price, you would need to make $19,000 more on average to qualify at today's interest rates. In scenario B, if you wanted to keep the monthly payment the same, but interest rates have risen by 3%, resulting in reduction of purchase power, in this case, the 2023 buyer would need to find a home at a purchase price well below the median sales price, a reduction of about $70,000. So what does this mean to the average buyer? They will need to consider purchasing a smaller home to build up equity and purchase their larger home in the future. If home prices are not going to adjust, the next question we're asked, will interest rates provide some relief? And the quick answer is just slightly, ever so slightly. Interest rates in 2023 are predicted to be in the 5.75 to 6% range. In March, we ended above 7 for conventional loans. The good news is FHA rates, NBA, have dropped slightly below 6% for a period of time this quarter. A reduction of 1.25% makes a significant difference on the payment. Also, FHA has lowered their mortgage insurance premium, making it more affordable. Let's take a look at an FHA loan today. At 6% with 10% down, now that is higher than the FHA minimum of 3.5%, and at a median sales price of $425,000, the monthly payment would be $29.25. With inflation seeming to settle down somewhat, the majority of mortgage rate experts are expecting rate reductions in mortgage rates to occur sometime in the second quarter. However, there is no prediction for rates to drop below 5%. The average prediction is being between 5.5 to 6%. An article published by Forbes magazine provided the mortgage rate industry projections have been updated, and you can see that here on this graph. What do homebuyers need to plan for? Purchasing a home at an average interest rate for the last 50 years, which is around 6%. We expect that to be for the next few years. Of course, pending any type of financial crisis that might hit the market, that could also affect interest rates up or down. The third item is supply and demand. Will demand increase or decrease in 2023? We expect buyer demand to increase mildly in the second quarter, leveling out with as interest rates level out sometime in May. If rates do drop quickly below 6%, then we expect demand of buyers to outpace inventory for a short period. We are encouraging our buyers to get ready and be ahead of the crowd. When interest rates do drop, those waiting to purchase are all going to move forward at the same time. This will decrease buyers' inventory options and buyers' negotiations on terms. Let's talk about the rental market because that affects a lot of our future home buyers. The median rent for a single family home has followed the sales market and has flattened out for the last 3 months at $2,000 for an 1,812 square foot home. The median price per square foot is about $1.15, with new homes and updated homes still obtaining a premium. The days on market, that means the time it takes to lease a home, has flattened as well, quarter over quarter, at about 28 days. As a reminder from our last report, the most significant qualification for landlords is 3 times the rent for monthly income. From the household income graph we mentioned earlier, this means that less than 47% of households in Southern Nevada can afford the median rent. So what's in store for 2023? Let's talk about sales prices. We are expecting the median sales price to stay relatively flat with some slight increases in the spring and summer months. We do expect that if interest rates drop below that 6% mark, that we will have a good portion of buyers enter the market at the same time. And with this reduction in inventory, this may cause prices to jump up during those months. We expect interest rates to be in that 5.85 to 6%, 6.5% range, fluctuating as economic reports are released. The third question that people ask are foreclosures. Are they going to rise? We expect foreclosures to stay at very low levels. Today's homeowners simply have way too much equity, and most have really low payments and can afford the home. To see if interest foreclosures rise of any level of significance, you'd have to have mortgage defaults really jump up. Now, we have seen a slight increase in mortgage defaults, but it's a long time frame from those defaults, first payment defaults, to actual foreclosure, and the path to work that out is pretty lengthy and gives lots of opportunity for those sellers to make those payments up. In regards to inventory, we had expected inventory to stay higher due to the affordability issue. However, inventory took a significant drop by the end of March. With less sellers entering the market, and we predict more buyers entering the market, we're going to stay below that 1 to 2 months of inventory. Reduced rental rates? No, we don't think that's going to happen. We think they're going to stay flat. They're going to stay around that $1.15 for the rest of the year. So what can our home buyers expect? Moderation. We had a buyer's market between September and January, and now it is moderated. With a limited number of homes being listed, buyers' options will be reduced. We don't expect to be a drastic reduction, but not as many options as they had over the last 6 months. Although they won't be rushed to make a same-day decision or go back into that frenzy we experienced the spring and summer of last month, we do expect, with the reduced amount of inventory, the time that a home is on the market will go down. Buyers, be prepared. Our greatest advice we can offer you is to get ahead of the other buyers that are going to be hitting the market at the same time. Be ready and walk through a solid plan so that you can have success. We've held a lot of buyers consultations over this first quarter, which allowed our clients to do the small things that help them move their credit score slightly. Even those with excellent credit can move it up a little bit more, saving them on the interest rates. Be prepared and get ahead of the buyers who are all going to wait until interest rates drop. Once those rates drop below the 6% mark, we anticipate a pretty good-sized flood of buyers to enter the market all at the same time. With low inventory, this will remove a good portion of the incentives and the positive terms being offered to today's buyers. Right now, our buyers are seeing less out of pocket expenses, no more over appraisal value offers. Sellers are willing to contribute to buyers' closing costs, and sellers are willing to accept offers with down payment assistance programs. Right now, buyers are just getting simply more favorable terms. Sellers are being more reasonable on the repair request. That means buyers can ask for certain things to be addressed in the home, and they don't have to worry about it. And buyers can think about the home they want to tour and take some time to decide which one works best for them. However, we are expecting days on market to reduce. And now we're not currently right now we're not dealing with a whole lot of competing offers, but as we mentioned, we're starting to see the market shift to that. So there could be competing offers on homes coming up in May and June. We are able to negotiate for our buyers longer close of escrow for those who needed it for a lease termination date that's further out, or they just had simply another reason why they needed to close at a later date and time. Sellers are being more negotiable on those terms. Affordability is still going to be an issue. So, with interest rates expected to be in that 6% range, buyers are still going to have to deal with that affordability challenge. We encourage our buyers to consider purchasing a lower price home, a smaller home in a different area than their long term home would be. This will allow them to build equity and then move when they have the source of funds and the income to purchase that next home or their forever home. More buyers can afford a home smaller than with less amenities or features in a different location than they are hoping for. Lastly, as we mentioned, renting will still be expensive. To put it in perspective, if you rent a home for $2,000 for the next 3 years, you just paid your landlord $72,000 with no equity and no personal gain. Price to market has always been solid advice, but in today's market, it is super important. Our advice is to be realistic about your current home value and be patient. Plan on a 60 to 90-day window. Your home will get a lot of tours before a buyer's offer is received. Buyers want to see many options before deciding on a home in today's market. Thank you for watching our housing market update. As I mentioned in the beginning of this update, we are starting to see the housing market shift. We are less than 2 months of inventory as we're giving this report, and that means we're going to see the buyer's options starting to reduce pretty significantly. And if rates drop in May as we're anticipating, that means we're going to see another flood of buyers entering the market, and that's going to get some more pressure on the inventory. So buyers and sellers beware, we are starting to see it shift. Please contact us if you have any questions about this report or you have general questions about what's happening in your neighborhood or a neighborhood you're looking to purchase in. Please don't forget to share this report with your community. Thank you.